Chapter 3 for Principles of Accounting 1. So, in Chapter 3, we're going to complete our accounting cycle. In Chapter 2, we looked at journal entries, posting. We also talked about preparing financial statements from a trial balance. And now we're going to talk about how we close our books at the end of the year. Okay? So, we have an accounting period. Accounting periods can be any amount of time. We can have monthly accounting periods, quarterly accounting periods, semi-annual, so twice a year, or annually. Um, Regardless of what we choose our accounting periods to be, what we have to decide as a business is how often we are going to close and restart our accounting records. At a minimum, this has to be done every year. Whether we choose to do it quarterly or monthly is up to us and how we have set up our accounting systems and records. We do have to do it yearly, though. So we have two different types of accounting. The accounting that this class focuses on is accrual basis accounting. And this is that revenues are recorded when products or services are delivered and expenses are recorded when they incur. We teach accrual basis accounting only in accounting classes because that is what is required for US GAAP. So all businesses that have to follow US GAAP rules, including corporations, all government entities, and a lot of private businesses still have to follow GAAP reporting. They have to follow accrual accounting. So usually the only companies that follow cash accounting are very, very small companies, individually owned companies with only one location are generally the only kind of companies that do cash basis accounting. Otherwise, the standard default is accrual basis accounting. When we look at accrual basis versus cash basis, it's how we recognize revenues and expenses. So this is an example of prepaid insurance where we paid $2,400 for 24 months of insurance. And so we use that insurance expense every month for 24 months. We match the expense with the period that benefits by the insurance coverage. This follows the matching principle that we talked about in Principles of Accounting 1, where we have to match revenues and expenses. So again, all of this is required by GAAP. Under cash basis accounting, we recognize when cash is involved. So we would just say it was an expense for $2,400. We would record it on the day that we pay the cash and we would not carry it through. As I said earlier, the only companies that can use cash basis accounting are very small, independently owned companies. Recognizing revenues. So we've already had some discussion in the last two chapters about unearned revenue. So this is part of that revenue recognition principle that we talked about in chapter 1, that we can only record revenue when the goods and services are provided to the customer and at an amount that we're going to receive from the customer. So if the customer prepays us for revenue, that becomes unearned revenue, which is a liability to the company. And we can't move it into our revenue account until we have actually provided the good or the service. So an example of this is when you buy concert tickets. So you might buy concert tickets 6 months in advance and you pay for the concert ticket. That company that is selling you the concert tickets cannot recognize any of the proceeds or revenues until the concert actually happens. So until then, this is a liability in their records saying that they need to provide a good or service to people in order to collect this revenue. And this matching principle, we're recognizing expenses. So what the matching principle states is that expenses are recorded in the same accounting period as the revenue. So we match expenses to revenues. When this happens as part of the accounting cycle, it's called an adjusting process. So when we close our accounting records, because each year when we do full financial reporting, we have to maintain all of that accounting information in that year. So what we do is we close our accounting records and then we start the new year fresh. Okay. I'm not saying that we empty all of our accounting records. There's a process and only some accounts get moved. It's really about revenue and expense accounts. That revenue and expenses have to be recorded only in the period in which they happen, and they can't be carried over into the next year. Okay, so we call this the adjusting process. So we have adjusting entries. So in chapter 2, we looked at journal entries for regular transactions as part of our company operations. We recorded those transactions, we posted them to T accounts, and then we made a trial balance. Adjusting entries happen after the trial balance. So we've made the trial balance saying that our accounting records are good, there are no mistakes, nothing has been put in the wrong place. So now we're going to do adjusting entries after the completion of our trial balance. The types of adjusting entries, they're only related to expenses and revenues. So do we have unearned revenue that has now been earned? Do we have prepaid expenses that we've used up? So did we prepay insurance and rent and now we've used that up? So those are different examples of adjusting entries. So we're going to look at these in deeper detail. So the first is these prepaid expenses. So this is prepaid insurance, prepaid rent, supplies. So they're assets on our accounting records. We have supplies that are available for use. We prepaid a year in advance for insurance, so we're promised 12 months of insurance. We paid a year in advance for rent, we're promised 12 months for rent. As we use that rent, insurance, and supplies up, then we have to adjust that account. Often when we're talking about supplies, we're talking about post-it notes, pens, paper, ink. So we don't, every time that somebody goes to our supply closet and takes a set of post-it notes, we don't record an accounting transaction for that. What happens is that we buy a bunch of supplies, and then at the end of the accounting period, we go and look at our supply closet and see what has been used. And then we record an adjustment to account for the use of supplies. So in this example, we're looking at prepaid insurance. So we paid $2,400 to cover insurance for 24 months. We paid on December 1st of 2019. We've decided that our fiscal year is going to end on December 31. So we have this prepaid insurance beginning on 12/1. This insurance policy benefits us for 24 months. On December 31st, if that's the end of our fiscal year, we have to do adjusting entries before we can close out our fiscal year and start the next year. So we have to close all of our revenue and expense accounts. And the first process in that is adjusting entries. So now we have used 1 month of insurance. From December 1st to December 31st, we've used 1 month of insurance, and we're going to record a journal entry where we debit insurance expense and credit prepaid insurance. Okay. So now we have a balance of $2,300 in prepaid insurance, and we have an insurance expense of $100. Now, our balance sheet, when we prepare it for the year ending December 31st, we will show a balance in prepaid insurance of $2,300. And on our income statement, we will have an insurance expense of $100. So the general journal, then, when we look at the balances, we can see our T accounts and see the information in there. And then this is the journal to record that expired insurance. Now let's talk about supplies. So we have that we purchased $9,720 worth of supplies in December. And then at the end of the month, we go through and look at what we have left. And we've decided that we have $8,670 worth of supplies. So we need to record an entry that states how much supplies we used during the month of December. So it's the difference between what we had in stock, the 9,720, and what our balance is of that 8,670. So we have an adjustment of 1,050 that says we used supplies up during the month. That becomes a supplies expense, which ends up on our income statement. So the balance sheet will show that we still have supplies remaining, and the income statement will show 1 month of supplies expense. Okay. So the journal entry to record that is a debit to supplies expense and a credit to supplies for the amount of supplies used. We'll continue to talk about adjusting entries, or we'll do this example on adjusting entries in the next video.